focus to the sector that the markets have been loving, the banking sector. IDFC First Bank's board has given their approval for fundraising of about 3,000 crore rupees. The stock also had a stellar start to 2021 with a 56% rally so far. Joining us now is Vaidyanathan, Managing Director and CEO of IDFC First Bank. Mr. Vaidyanathan, good morning. Thank you very much. The board approval is with you, but you just raised money, isn't it? 2,000 crore from Warburg. Is this just because the market is kind and so you want to make use of it and prepare for growth? What's the purpose of this back-to-back capital raising?
First of all, it is not from Warburg. They were one of the investors, but it was that 2,000 crores were from a large number of investors, basically largely insurance companies. But that 2,000 crores Lata raised maybe about in June of 19. Or 20, sorry, was in the context of the fact that because of the large accounts we know, Dewan, Reliance Capital and a few other accounts, we had lost a lot of capital, all legacy accounts, and we wanted to enter COVID with a even more period of strength and confidence. That's the 2,000 crores at that point of time. The good news is that since that time we have never posted a loss, so obviously all that money has gone towards growth. Now we are seeing a very strong growth opportunities, from here on, because you've been hearing the latest just now, how things are coming back in India across all sectors. So for that growth, we wanted to be really well capitalized, and we see really a fantastic time on the horizon in terms of lending opportunities for us.
Okay. Can you give us some idea of how asset quality will pan out? As you said, it has not been as bad as you thought, but nevertheless, if you can share some numbers on what was the amount of restructuring required, what is not counting Supreme Court, your stress loans, and how much might it rise?
Okay, since our biggest piece of the business that, Lata, you've been tracking for a while is the retail lending business, largely MSME, consumption, and so on and so forth. Let me talk about the retail NPA. Our pro forma NPA on the retail side post-COVID as per last quarter was 3.88%, and the net NPA was 2.27%. Now, the reported NPAs are much lesser, but let's not go there because they're not relevant. Now, we feel that we've been tracking collection numbers for the last 7 months, and frankly, every month it is improving. I'm happy to share that as per December, for the standard buckets, the collections have reached 98%. January is even better. So we feel that in the next 3 quarters or so, our retail NPA will come down back to 2% gross and 1% net. That's our guidance already given in the next 3 quarters based on the collection trends we're seeing. So we are feeling very comfortable on the retail lending space.
Okay. So then let's talk about growth, Mr. Vaidyanathan, because in the third quarter itself, I mean, even the wholesale book, the retail book, whether I look at it Q on Q or Y on Y, there was growth. So now that you're confident of asset quality and if this recovery continues, then for FY22, what's the vision and the target?
See, our loan book last year has grown by 24% on the retail side, which is the big machine we are firing at this point of time. Not at this point of time, for 10 years now, I think. We have put out a public guidance that we feel confident of growing at 25% year on year for many years to come. So this capital of 3,000 crores actually will take us to upwards of what CET1, core equity itself of close to about 15.5 to 16% or somewhere in that zone, and that should give us good strength to take care of that 25% sort of loan growth we are expecting even in the upcoming year, 21-22.
So since the bulk of the growth is coming in from the retail book, and it's your stated intent that that's how you want to sort of build and grow the bank, there is always a concern around unsecured lending, or whether whether it's credit card loans or any other form of personal loans, whether at some point they can start posing a challenge. Your thoughts?
Naturally, I'm going to ask you the same thing, Mr. Vaidyanathan. The latest CRISIL report day before yesterday said that of all the areas they see maximum stress in unsecured personal loans and unsecured MSME. How much is that for you?
No, I want to explain that. I feel it's a very rather blunt instrument being talked about when people just use the word like unsecured or secured. Actually, let's think about JLG business, the MFI business, and so on and so forth. Let us think about cash flow lending we do to entrepreneurs, etc. Our gross NPA, I told you, even post-COVID, remind you, post-COVID is 3.88 gross, right? Which I'm telling you will come down to 2 and 2 3/4. But for the system, this is anywhere close to, as you know, close to about 18-20% for public sector banks, and maybe for private sector banks anywhere between 4 to 5% as per the Civil TransUnion report. So we have very deep specialization. Number two, so basically key point is we do cash flow based lending. We should not just bluntly use an instrument called secured unsecured. Secondly, we do, for example, we do group lending to women borrowers. I mean, we lend 25,000-30,000 rupees. The repayment is as good as 100%. So are we better off lending unsecured to a poor woman who's willing to pay you back 100%, or you want to give secured loan to an infrastructure or a corporate who's going to blow the hole into your balance sheet?
No, I got that. Now, one of the best parts of the Q3 numbers, I thought, was the way in which current and savings account have grown. 48.3% is the current and savings account ratio now, or low-cost deposits. That's really mind-boggling for a small bank to be able to get so much of cheap liabilities. Do you see this? Do you see your ability in this front to continue, and therefore are margins going to improve? Already 4.65.
For the short answer is margin will definitely improve, and it's more like what you've been seeing the trend, Lata. It was 1.56% pre-merger, already touched 4.56. Very happy about that. But you see the trend. That trend will continue to look up. We feel quite confident about that. But on liabilities, Lata, I must specifically to you, personally point out to you that the first interview you did with me at that point of time, in a 15-minute interview, it came back to that point 6 times, saying that, look, it's very, very hard to grow it. I'm very happy, you're acknowledging it, that we did it. And, CASA of a 48%, a 48% CASA puts us in the league of really good banks. And, we felt so flush with cash that we reduced interest rate from 7% to 6%. That itself will improve our margin, of course. We did it just a month ago. Going forward again, as the, cash in the bank increases, we could further look at reducing rate, maybe many months from now. But we're feeling really good on the liability side. And that's the foundation. Now we feel very confident of growing loans because liabilities is very, very well protected for the bank.
Yeah. I had a quick final question on the fact that, growing the liability side. Just saw a branch come up in Juhu in one of the marquee streets here. So going forward, will it be easier for you to build these branches and build the network, say, in tier 2, tier 3 cities? Because perhaps tier 1, Bombay and Delhi, there's a big fight already with the bigger, more established private sector old names?
First of all, it's not about how many sectors of the players are in which sector, etc. We love tier 2, tier 3. We just love it. You know that business for many, many years. It goes back 8-10 years. We just love that space because people have the deposits, people have the borrowing capability, and it's underserved, unorganized. We love all such things. So definitely we will, that's the segment we'll grow more of branches in. Urban markets, we have enough deposits. Frankly, for the number of branches we already put up, we feel that our funding capability for the next 1 year is kind of sorted. So, we feel we'll go slow on branches from now on, at least on the urban side, and now be able to, with a strong liability base, to grow the asset side. So, I must say that since this is a commentary of first interview I'm giving after the announcement of the results, let me just say, say this to shareholders because who might want to know why you're raising 3,000 crores. And what's good about that? I feel, first of all, I want to say that, of course, it's a fortress balance sheet, feels good for growth coming forward. But secondly, we have some very unique capability. We are playing in a $500 billion market on the lending side. It's a big market, underserved. Collection capabilities are strong, good yield, low cost of funds. We are feeling very good about the future. I hope you feel as well.
Okay, well, I must squeeze in a last question, Mr. Vaidyanathan. You said you brought down the deposit rate from 7% to 6%, but you are still raising at 6%. SBI is raising at 2.75. So there is always this fear: will you be lending to more risky bets?
No, Lata, this is a misconception actually. Everybody chooses that segment. You could be lending at 6.85 or 6.7% home loans and make no margin at all. I mean, maybe it makes margin for them, but may not for us. So, you may lend at 6.7 and make no money at all, or you could lend to small entrepreneurs or consumers or so on, and make a hell of a lot of margin, like 4.6% you're already making. So, which one would we choose? It's pretty obvious.
All right, point taken.
So, therefore, the second thing is that, something very interesting is going on here. Our lending model is proven. Now, all we have to do in due course is to keep bringing down the cost of funds with greater brand awareness, greater capability. See, we are a 5-year-old brand vis-a-vis SBI being maybe 200 years old. So I think over time, as we get greater traction, we keep bringing down cost of funds. I think margin will increase through that factor alone.
All right. We'll leave it at that. Mr. Vaidyanathan, thank you very much indeed for joining us, and all the very best for a glorious 2021.
Same to all of you at CNBC TV18. Thank you.
Okay.